of the San Diego Housing Commission Board of Commissioners. It is 8:02 on November 12th, 2021, and I'm calling to order the special meeting of the Housing Commission's Investment Committee. Okay, sorry. The process we're using for today's meeting is authorized by Government Code Section 54953E, which was added by Assembly Bill 361. This allows the committee to use teleconference and provide the public with an opportunity to address the committee through a call-in or internet-based option during a proclaimed state of emergency. San Diego City Council on November 2nd, 2021 declared a continuing state of local emergency regarding the COVID-19 pandemic. Our meeting is occurring by video conference with all the committee members and the Housing Commission staff participating by video. For the record, I'll ask each committee member to indicate their presence and say their name. Brian Klumpner.
Here.
Thank you. Keely Hubbard.
Present.
Good morning. Now, members of the public are in attendance. However, members of the public may watch the video conference and hear the audio of today's committee meeting, which is being streamed live online. The agenda for the meeting included a link to the website for the San Diego Housing Commission Board of Commissioners meeting, where the public can access the live streaming for today's committee meeting. The public has been provided with an alternative opportunity to provide comments to the committee through an online comment form and a toll-free phone number. A link to the online comment form was included on the agenda for today's meeting, which was posted on the Commission's website, www.sdhc.org, on Monday, November 8th, 2021. The agenda and public comment form explain that comments about items on the agenda will be read into the record if submitted by 4 p.m. yesterday, Thursday, November 11th, 2021. Non-agenda public comments submitted by 7 o'clock this morning will be read into the record. In addition, members of the public who wish to speak on an item may call the toll-free phone number that is included in the agenda. Members of the public monitor the meeting through the live video streaming available through the Commission's website, www.sdhc.org. Again, today's agenda includes a link to the website where the public can access the live streaming for today's meeting. Members of the public should call the toll-free phone number only when the item they want to comment on is introduced. If you call and try to comment on an item that's different than the one that's being considered, we'll ask you to hang up and call back at the correct time. Members of the public will have 3 minutes to provide their comments each, but if there's a large number of comments, we may limit them to 1 minute each. Non-agenda public comments. The phone line is now open to provide non-agenda public comments. You can call 833-610-2513 to be placed in the queue to provide non-agenda public comments. Thanks, Scott. This is the time when members of the public may provide comments to the investment committee about topics that are not on the agenda but involve a subject within the committee's area of responsibility. We cannot take action on non-agenda public comments, but again, that number is 833-610-2513. There was no written non-agenda public comments submitted for today's meeting, but I'll ask our Vice President of Communications, Scott Marshall, if we have any callers for non-agenda public comments.
We have about 50 seconds left on the clock and no callers.
Thank you, Scott.
I'm going to come up with 50-second bingo for 2022. We can do.
My heart stopped when Scott said we have about 50, and I was like,
I was saying,
what happened here?
Oh my gosh.
I thought the same.
That would be wild. I would love to know what sort of comments those would be.
Yep.
You guys are all cynical.
Well, we know you have a meeting right behind us, though. So
we do. I get to give that whole speech again. I'm coming out of a cold too, so like I can't pronounce words right, and I hear myself like.
You sound fine.
Oh, you're kind. I'm driving the struggle.
The time has expired and we don't have any callers.
Thank you, Scott. This concludes the non-agenda public comments. We'll move on to committee member comments. I'll ask any committee members who would like to make a comment to do so now. Okay. Next on the agenda is the approval of minutes from the meeting on March 5th, 2021. The phone line is now open for public comments about the minutes. Please call 833-610-2513 to be placed in the queue. There were no written public comments submitted, but again, if you'd like to call in, it's 833-610-2513. Scott will go ahead and give you the power back.
We have about 1 minute and 10 seconds and no callers so far.
He didn't say 70.
I learned my lesson from the first.
Look forward to these meetings in person next year.
The time has expired and we don't have any callers regarding the minutes.
Thank you. This concludes public comment for the minutes. Do any committee members wish to make any changes to the minutes, or do I have a motion?
So moved.
Can I second? I'll second that. So we have a motion by Commissioner Klumpner, and seconded by myself. We'll go ahead and vote now. Commissioner Klumpner? Commissioner Hubbard?
Aye.
And I'll add my vote in favor. That passes unanimously. Agenda items. This morning, we have two informational items on the agenda: fiscal year 2022 first quarter investment results. First is the fiscal year 2022 first quarter investment results. I told you guys I'm not shooting 100 today. The phone line is now open for public comments about this item. You can call 833-610-2513 to be placed in the queue. We had no written public comments, but again, that number is 833-610-2513. We'll take those public comments after the staff presentation, during which we'll hear from Director of Audit and Reporting, Marie Lawless. Go ahead whenever you're ready.
Great. Thank you. Good morning, Chair Benvenuto and Commissioners Klumpner and Hubbard. I am Marie Lawless. I'll be presenting the first quarter, September 30th, 2021 investment report. Starting on slide 2, I would like to confirm that the Housing Commission's investment policy conforms to HUD Notice PIH 96-33 and California Government Code Sections 5,922 and 54,601. These guide the types of investments that can be purchased and specify the length of time the investments can be held. Next slide, please. This is a snapshot of the September's monthly investment strategy with that happens between Fiscal and the Housing Commission advisor. This ensures to ensure liquidity, we use a laddering approach, and additionally, none of the Housing Commission investments exceed 5 years. Next slide, please. This is the Housing Commission's investment portfolio by investment type as of September 30, 2021 and June 30, 2021. I'd like to highlight that September's investment portfolio market value was $191.4 million compared to $200.8 million at June 30th. The $9.4 million decline in market value was primarily due to the funds utilized for housing stability program assistance payments and loans made for multifamily developments such as Jamboree San Ysidro and East Block Senior. The overall portfolio yield was 0.93% in the first quarter compared to 0.98% in the prior quarter, which reflects the continued downward impact of the federal monetary policy on overall investment rates. Joe Foy, the Housing Commission's investment advisor, will discuss the U.S. and worldwide market conditions next. And lastly, I wanted to point out that the effective duration of the portfolio was 1.36 years at September 30th, which confirms that there's liquidity in the Housing Commission's portfolio. Next slide, please. And this concludes my presentation, and I'm here to answer any questions that you may have. Thank you.
Thank you. Do we have any callers at this time?
We do not have any callers.
This concludes the public comment period for this item. Committee members, do we have any questions or comments on this item? It's informational, so there's no action required, but once, twice, okay. Well, thank you. Our next item is the current investment market conditions. The phone line is now open for public comments about this item. You can call 833-610-2513 to be placed in the queue. There were no written public comments submitted regarding the item. And again, the number is 833-610-2513. We'll take public comments after the staff presentation. Joe Foy, the Senior Vice President of Institutional Fixed Income and Equities for Mishler, I hope I said the right, financial group, will be presenting this item. Please begin whenever you're ready.
Good morning. Thanks for coming in. I know you have a busy morning, so let's dig into this. Go to the next slide. Thank you. So we have a snapshot here. What I like to show is when we do invest, what we're investing in and how that affects the portfolio. And these goes under the core portfolio. Starting with, we list portfolio characteristics, whether it's market value, annual income, average coupon, portfolio yield, effective duration. And I'd like to go back a few years just for a basis to take a look. So as you can see, as of 9/30/2021, we had a market value of, this is the core holdings now, of $107,326,470. That will differ slightly from what Maria reports, and that's just simply their market value is from their safekeeper, where ours is from Bloomberg. And so it's just a slight difference. It's insignificant, but it is a difference. So if you pinpoint it and look at it, it will be slightly off. If you go back, you can see we are at 107 million. We are a little higher than we have in the preceding years. I think back in 2017, we were about 106 million. Our annual income is for this year, it will be a 3.155 million, based on a coupon of 2.94, the average coupon in the portfolio. That is down slightly from the previous years as we continue to see lower rates. The investments that we are reinvesting in have lower coupons, right? It makes sense. So we are down to a 2.94. Our portfolio yield is at a 1.34, down from a 2.06 at the beginning of last year. Tracy, Marie, and I, this was expected as bonds that we purchased in 2017, 2018, 2019 we had higher book yields. Those have matured, and we're reinvesting into lower rates. However, that's just part of the interest rate cycle. And as I'll present a little bit later, we're expecting rates to begin rising based on the Fed. And then our effective duration for core is a 2.36. If you recall at our last meeting in March, our goal has been for a couple of years now, but our goal was to try to extend duration with the yield curve, the steep yield curve. They're paying you basically to move out a little further out the curve. And so our goal was to extend duration at the same time. By extending duration, we would capture more yield for the portfolio. Next slide, please. Okay, this is our fixed income distribution. I always like showing this breakdown. A little bit less dramatic for government portfolios than private sector accounts, but still, it's a good visual for us. On the top left corner, you can see that we break it down by maturity, less than 1 year, 1 to 2, 2 to 3, etc. And I've been asked this question before: Why do we not have a very large percentage of securities in less than 1 year? And the simple answer is that the agency typically has 35, 40, 45% of their overall portfolio in overnight monies. And so there's no need to purchase securities inside of 1 year and receive a lower yield when we have the adequate liquidity in overnight monies. And so instead we push out the curve a little bit to capture more yield. This also demonstrates, as Maria spoke about, the laddering of the portfolio. We try to have 1 to 4 line items by every year and every month. So, Jan 23, Feb 23, March 23, we try to have a security that will mature every month. So that ensures that there's a cash flow coming into the Housing Commission. In case there's a project that needs to be funded, we don't necessarily have to pull out of overnight monies. Sometimes we do because there's some better opportunities to invest, but it's always nice to have that liquidity and cushion. You'll also note on the bottom, the 2 graphs, I have a maturity and effective duration graphs. So the maturity distribution is, reflected in the top left corner. The point of the graph is the effective duration. Because most of our bonds pay principal and interest every month, it in essence shortens our duration, it shortens our maturity. Thus, upfront, we get the benefit of having a steep curve and getting more yield, but at the same time, we get our monies back a little bit sooner than what its legal final says and able to put it back to work. Also, under the sector analysis, you can see we are now fully 100% government agencies. We had in the past, Maria, I think we were 5 to 10% at one point in FDIC CDs. However, that trade's kind of gone away. The markets are real tight in FDIC CDs, the structured CDs, perhaps 2 to 5 basis points above treasuries. So at this point, we might as well buy a treasury if we were going to do that. So what's the point? Treasury is a lot more liquid than an FDIC. So at this point, we are not reinvesting in FDICs. It doesn't mean in the future we will not, but at this point, it doesn't make sense. Next slide, please. So as we were speaking about, a lot has changed since our last meeting, and there's so many different topics we could touch on, but I think for the standpoint of our portfolio, the topic discusses the Federal Reserve, the FOMC. And at their most recent meeting, they announced, and it was expected, that they will begin tapering of the bond buying, the QE program, by 15 billion less per month. They will go from 80 billion a month to 70 billion a month in treasuries, and 40 billion a month to 35 billion a month in MBS. So as a reminder, what is QE, right? It's basically the Federal Reserve comes in and they buy riskless securities, treasuries, and mortgage-backed securities to ensure liquidity in those financial markets. However, the real effect, when you speak with it, the real effect is they want to reduce the availability of riskless assets, thus forcing large institutional investors or any investor to move into a little more riskier assets. And we'll see in a slide later about how that affects in the equity markets. So I wanted to read we've got a second. I just wanted to read a couple of comments from the Fed because it's being called a dovish taper. If you recall in our previous meetings, right, a committee member that's a hawk is a member that believes that tighter monetary policy is overall better for the economy, as opposed to a dovish committee member who believes looser money, easier money is a little bit easier. So this is being called a dovish taper. Chairman Powell goes on to say that with progress on vaccinations and strong policy support, indications that economic activity and employment have continued to strengthen. The sectors most adversely affected by the pandemic have improved in recent months, but the summer's rise in COVID-19 cases slowed the recovery. Inflation is elevated. Yes, it is. Largely reflecting factors that are expected to be transitory. Supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. So he's acknowledging that, yes, there is inflation. He believes, and the committee continues to believe that it's transitory because of the supply side bottlenecks. He goes on to say about, I repeated about reducing the QE. However, he finishes by saying the committee judges that similar reductions in the pace of net asset purchases will likely be appropriate each month, but is prepared to adjust the pace of purchases if warranted by a change in the economic outlook. So what many believe he's saying here is, if it truly is not transitory, if it truly is not just a supply side issue, if demand as COVID unwinds, then perhaps he would slow his, he would continue to buy these securities to make sure we have accommodating policy. Yeah, you'll never see the Fed does not raise rates without first reducing or stopping their purchases of treasuries and government agencies. Next slide, please. Oh, I'm sorry, go back. I'm sorry, go back. I'm sorry. So in this graph here, the graph on the left was from our last meeting. As you can see, these are Fed Fund futures graphs. These are real markets that are trading the expectancy of raising of rates. As you see on the graph on the left, on the far right, you can see number of hikes was basically zero, right? Now, as you present day, as of November 7th, you can see real money's trading hands here now. That by July or September of 2022, they are expecting one hike. And it correlates, these graphs have been pretty accurate in history historically. So this correlates, and it tells the markets, it's telling us that do expect the Fed to raise rates sometime in third quarter of 22. And again, if you do the math, if we wind down 15 billion a month, that should, it ties into the fact that we'll be done having to buy back any bonds, and we could start the tightening process. Okay, next slide, please. So every quarter, the Federal Reserve comes with summary of economic projections. And as you can see on the far left under the variable, the June prediction for a change in real GDP was at 7%. However, reflecting on the supply bottlenecks, they have readjusted that to a 5.9. But you can see in 2022, they are projecting it back up higher because I think that, again, the supply, they believe the supply chain issues will work itself out. Unemployment rate, as you can see, in June, they were thinking 4.5. They've raised that now to 4.8 because of the unexpected, higher than expected people not wanting to go back to work. And so they've adjusted that number. For whatever reason, in 22, 23, they think that'll level out. Inflation, the PCE inflation, both core, which is less food and energy. Again, it acknowledges from their June projection, acknowledges the fact that there is supply chain issues. But again, they're pretty confident that it'll work itself out in 2022. And on the last column, you can see the Fed funds projection. They've moved that up a little bit higher in 2022 to where it's half a move, but for sure, but 2023, one full move. Next page, please. And back to what we were talking about with QE, you can see this is, back on the 7th, second to the right side column there, you can see that year to date in the equity markets throughout the world, for the most part, up 15 to 30%. So again, it's forcing investors into riskier assets. Then the chart on the right, as you can see, these are world bond rates. And again, even though we have the ECB, BOE, BOJ, all on board of how they want to tackle the pandemic with their lower rates, you can see the rest of the world, with Switzerland, Australia, Portugal, France, their 2-year is still negative. So you look at United States at 0.41 and UK and Australia, at least we're at a positive rate. So while all the central banks in the world, they typically work step in step together. At this point, the rest of the world, most of the rest of the world is not ready to move to higher rates like we are. So in content for the portfolio, higher rates, we welcome higher rates with our portfolio. It allows us, since we have 35 to close to 50% in overnight monies, higher rates helps us. Higher rates helps assist us when we are going to reinvest. So for government portfolios, we're not a total return portfolio. We want higher rates so we can, reinvest and get a little more cash flow. That concludes my economic updates. If we have any questions from the board.
Thank you. Scott, do we have any callers at this time?
There are no callers.
Thank you.
No way. Kidding.
I was like, oh gosh, there's somebody here. That concludes the public comment period for this item. Committee members, are there any other questions or comments? Okay, well, I'm generally taking away that was positive. So thank you very much for all of that. This is an informational item. There's no action required. If there's no objection, we'll go ahead and adjourn our special meeting today. Okay, this meeting is adjourned at 8:26 p.m. Thank you, everybody.
Thank you.
Thank you.